Retirement in America is about to change. Trump just signed an order that lets retirement plans invest in private companies, real estate, and even cryptocurrency. These options used to be reserved for the wealthy and big pension funds. Now, everyday savers could have access. Supporters say this means bigger returns and protection from stock market swings. Critics warn it's higher fees, harder to sell, and a lot more risk. For decades, 401ks were limited to stocks, bonds, and mutual funds. Easy to track, easy to sell, and transparent. But soon, alternative assets will be on the menu: private equity, real estate projects, infrastructure, commodities, and even Bitcoin. Imagine buying into SpaceX before it goes public, or owning a piece of $1 billion real estate project. Sounds exciting, right? But here's the catch: it's not cheap. Mutual funds often charge less than 0.5% in fees. Private equity funds, they can take 1% to 2% plus up to 20% of profits. On top of that, transaction fees, custodial fees, and hidden expenses. Unless you read the fine print, you might not even notice them. Then there's valuation. Stocks update daily. Private assets might only update once a quarter, or once a year. And liquidity. Stocks sell in days. Some of these investments could lock up your money for years. That's why age matters. Younger workers might afford the risk. Retirees could get stuck if markets turn against them. The administration says this will diversify portfolios, spreading risk beyond Wall Street. But don't expect changes tomorrow. The Department of Labor and SEC have 180 days to finalize the rules. Realistically, you won't see these options until 2026. And not every employer will add them. Some fear lawsuits if workers lose money. Others may wait for stronger legal protections. So what's smart? Many experts suggest no more than 5% to 10% of your retirement savings in alternatives. That way, you get upside potential without putting your future at risk. These assets do have real strengths: steady income from real estate, toll roads, or infrastructure projects. Plus, some can move independently of the stock market. But crypto? That's the wild card. It's volatile, unregulated, and not insured like bank deposits. Prices can crash 50% in months, sometimes days. Hackers have stolen billions, and if a platform collapses, you could lose everything. If you add crypto at all, treat it like a lottery ticket: small, high risk, never the core of your retirement plan. Who benefits most? Younger workers with time on their side. People with extra income streams. And savers who can afford professional advice. But retirees who depend on one account for bills. They need to be extremely cautious. Bottom line, don't rush. Pay attention to updates from your retirement plan, and only invest in what you fully understand. This change could reshape retirement for decades. But will it help protect your savings, or expose them to new risks? Tell me what you think in the comments. Would you put part of your 401k into crypto or real estate? And don't forget, hit subscribe, share this with someone planning for retirement, and stay tuned. The next wave of changes could impact your Social Security, Medicare, and future income even more.